Most people believe their money is available whenever they want. You assume the digits on your screen represent a physical pile of cash sitting safely in a vault. But the reality of the banking system works very differently than most people think. The moment you deposit your paycheck, that money ceases to be your private property. It becomes an unsecured loan to a private institution. And the real rule behind access to your money is rarely explained by the people who manage it. Inside the global financial architecture, your access to liquidity is entirely conditional. It is a privilege granted by the system, not a right guaranteed by law. Once you understand how structural control works, full access to your life savings looks very different. This analysis examines the institutional frameworks and systemic traps embedded within the modern banking structure. We are moving toward a period of extreme structural stress where the illusion of ownership is being replaced. It's replaced by the reality of institutional priority. This is not about a temporary glitch or a local error. This is about the fundamental way the financial system is designed to protect itself. It protects itself at the expense of the individual depositor. Imagine waking up tomorrow and finding every ATM in your city is dark. You open your banking app only to see a notification that withdrawals have been suspended. This is not a scene from a dystopian movie. It is a programmed feature of the modern financial system. In the eyes of the law, you are not a customer in the way you think. You are an unsecured creditor. This means that in a moment of systemic instability, the bank has the legal authority to freeze your accounts. It freezes them to ensure its own survival. Most people are unaware of the bail-in clauses quietly integrated into international banking laws after the 2008 crisis. These laws shifted the burden of bank failures from the government to the depositors. If a major institution faces a liquidity trap, they no longer need a taxpayer bailout. They can simply reach into your account and convert your cash into bank equity to stay afloat. Your money is used to pay for their mistakes, and you are left holding worthless paper, while your access to the world is cut off overnight. The system relies on a delicate balance of confidence and hidden mechanics. As long as everyone believes the money is there, the machine runs smoothly. But the internal plumbing of the global economy is currently under immense pressure. The gap between the total debt in the system and the actual physical cash available is wider than ever. We are living in an era where the digital representation of wealth has completely detached from reality. This creates a hidden institutional power that can be activated the moment the math stops making sense. We often hear about liquidity as a technical term. But for you, it is the difference between being able to buy food and being locked out of your own life. Banks operate on a fractional reserve system, meaning they only keep a tiny percentage of your money on hand. The rest is gambled in the derivatives market or tied up in long-term debt. If even 5% of depositors decided to withdraw their funds at the same time, the entire structure would seize up instantly. The bank doesn't freeze accounts because they want to steal from you. They freeze them because they physically do not have what you are asking. If you want to understand how these hidden financial mechanisms work before they affect you, consider subscribing. Because most people only discover how the system is truly wired after it is already too late. The catalyst for an overnight freeze isn't always a massive market crash. It can be something as subtle as a change in capital flow requirements or the introduction of central bank digital currencies. These new systems are being designed with programmability, which is a polite way of saying ... The issuer can decide where, when, and if you are allowed to spend your credits. We are moving away from the era of anonymous physical cash and into a period of total financial visibility. In this new reality, a freeze isn't just a response to a crisis. It is a tool for systemic management. The trap is already set in the fine print of your account agreement. Those dozens of pages you scrolled through and clicked accept on contain the legal framework for your own exclusion. They give the institution the right to flag any transaction as suspicious and hold your funds indefinitely without a court order. They allow the bank to limit how much of your own wealth you can move in a single day. These are not safety features for you. They are walls built to keep the capital inside the system. ... When the exit doors start to get crowded. The reality of the situation is that the system is built on the assumption that you will never ask for all your money at once. But as debt levels reach a breaking point and the value of the currency continues to erode, that assumption becomes dangerous. There is a slow systemic erosion happening right now, where your purchasing power is being bled dry by inflation. ... While your access to what remains is being tightened by regulation. Most people will only realize the cage has been locked when they try to turn the handle. True preparation requires stepping outside the traditional digital enclosure. Diversification is no longer about having different stocks in the same brokerage. It is about having assets that do not require a bank's permission to exist. Physical gold and silver have served as the ultimate insurance policy for thousands of years, because they carry no counterparty risk. When the power goes out or the bank's servers are down, a gold coin is still a gold coin. It exists in physical space, independent of an algorithm or a board of directors. Furthermore, maintaining a strategic reserve of physical cash outside the banking system is essential. In an overnight freeze, cash is the only thing that maintains local velocity. It allows you to navigate the first few weeks of a liquidity crisis while everyone else is staring at a system unavailable screen. Finally, diversifying into tangible assets like land, tools, or essential supplies provides a layer of security that digital digits can never match. You cannot eat a bank balance, and you cannot trade a frozen account for fuel. The institutional asymmetry between you and the banking structure is absolute. They have the data, the legal teams, and the keys to the vault. You have a plastic card and a hope that the system remains stable. But history shows us that systems do not remain stable forever. They reach a point of maximum tension and then they reset. These resets never happen with a warning. They happen on a Sunday night while the markets are closed, so that by Monday morning, the new rules are already in place. Understanding this mechanism doesn't mean living in a state of constant panic. It means recognizing the structural reality of the world you live in. It means moving from a state of blind trust to a state of informed preparation. The illusion of ownership is a comfortable one, but it is an illusion nonetheless. In a world of digital control and systemic debt, the only true wealth is the wealth you can touch, hold, and control without asking for permission. As the global financial architecture continues to shift, the window for moving your capital into safer, more tangible forms is slowly closing. The rules are being rewritten in real time to prioritize the survival of the institution over the solvency of the individual. When the freeze eventually happens, it will be justified as a necessary step for public safety or economic stability. Or will you be the one who saw the cracks in the foundation before the walls started to lean? Clarity is the only tool that can protect you from a mechanism designed to be invisible. Have you ever experienced a moment where your bank restricted your access or blocked a transaction without a clear explanation?